All right, welcome back, my fellow profit seekers and capitalists, and welcome to all you new viewers. This is Rick Action Jackson, your growth stock guru. Thank you for joining us today. We're going to do some education, some entertainment today. Please do not consider any of this financial advice. I'm not a licensed financial advisor. If you like the ideas behind these stocks, please discuss them with your financial advisor before committing any money to them. The stock market's a scary place. You can lose money. All right, we got 3 new ideas today, or actually I'm revisiting 2 of the former ones I've done. One because it's up a lot, one because it's down a lot. But let's start with APP. And let's go to the chart. APP is Applovin. Here you see the 5-year chart. The stock was a monster for a long time, and all of a sudden it's fallen out of bed. I recommended it on July 22nd at $415, and here we are down at $311. Let's cut it down to 1 year. You can see on the long 5-year trend, it's right between the 200-day and the 90-day moving average. But if you cut those two, the data on those down to 1 year, you're below both the 200-day and the 90-day. This is a falling knife, but when you go back to the 5-year chart, not so much. There's a lot of support here between 320 and 250. I know it's a big range. Why is this stock going down? Let's start with that. This company has beat the earnings and revenues every single time it's reported in the last 8 years. The CEO is known for being conservative. I don't think he's ever missed an earnings forecast. And if he hasn't beaten the numbers on every quarter, he hasn't missed any. So let's go over those numbers. This company's been growing incredibly fast. It's been growing 60 to 80% a year for the last 3 years. What do these guys do? If you're a video game player and you play on the internet, you already know. Applovin is the YouTube of the video game industry. Almost everybody puts their games on Applovin. Almost everybody allows you to buy their games through the Applovin platform. And almost everybody advertises their games on the Applovin platform so that you know that a new game is out there. So the last quarter, the growth was a little bit disappointing. They beat the numbers, but they only beat it by a penny, and they only beat it by a few million on the revenue, and they had been coming in way above expectations most of the prior quarters. The first dip in this stock from October through April was a fear that AI was going to disrupt their business. And it's the exact opposite. AI is making it very easy to create a video game, but then where do you sell it? Kids don't buy video games at stores anymore. They try it out for free on the internet. If they like it, they download it and they pay for it. So the number of people that are creating video games have quadrupled. It's probably going to go up 10 times. So now Applovin has a lot more companies wanting to get their games in front of the regular game players, and they'll pay Applovin a good fee to do it. Now, Applovin's rates have gone up. And what they've decided to do to keep the pressure on the pricing is to open up their advertising to non-video game makers. Now, 80% of your video game maker out there is a single young man. And when I was a younger man, I used to handle the 401k plan at Complex Media. And Complex Media was the capital of young single men advertising online. And I know who their advertisers were. I mean, this isn't hard to figure out. It's booze, it's rubbers, it's gummy bears, it's sneakers, it's cars, it's the military. You know, the military recruits men this age, and they pay a lot of money to get in front of them. So I think opening it up to other industries is nothing but positive. And Wall Street is somehow interpreting this as a sign of weakness, that they need new revenue because the video business is not growing anymore. The video game business is growing just fine, thank you. So I'm willing to buy what we call a falling knife here. And I actually did buy some Applovin this morning for a couple of my relatives. I'm not a financial advisor. I got relatives that let me help them with their accounts. And I will buy more of it myself if it gets below 300. So, Jonathan Stanford, I know you bought it at 415. I would not be selling it here. I think their numbers are going to be fantastic. And let's go over these here. Just so you understand how fast this company's been growing. In the last 3 years, they've gone from $3.2 billion to $5.4 billion to $6.8 billion. They're probably easily going to go over $8 billion this year. And I think this could be a $10 to $12 billion company in less than 2 years. Their earnings, they're incredibly profitable. Their earnings right now are on track to over $15 in 2026. And Wall Street's predicting $20.50 for 27. I'm putting a 35 PE on this. This company's typically sold at a 30 to 60 PE. Right now, it's only at a 19. It's only been below a 30 PE in the last month for over the last 3 years. So a 35 PE, and I'm using a very conservative $24 earnings 2 years out. And I'm getting a $950 target. And I don't think that is aggressive at all. So buy more of this. All right. Next we have Celestica. And this is Matt Nervington, who asked me, he's looking for a way to pay AI. He doesn't want to pay these ridiculous PEs that are out there on some of these companies. What do I think of CLS? I like CLS a lot. You see this base here? The stock's been pretty flat for the last 12 months. It's got a great base. And Alan Shaw used to always lecture, the bigger the base, bigger upside space. I would put a compass on this, probably come up with a target. It's around 480, 500 on the fundamentals. My target is 540. And that's only using a 27 PE, price to earnings ratio. Their earnings forecast for this year is $11.38. They have signed enormous contracts with the companies that produce the servers that build the data farms. Right now, Wall Street's estimate is $19.84 for 2027. I'm not moving the multiple up on this, folks. I'm keeping it at 27. Why is the multiple so low? These guys basically build motherboards, all the stuff that the semiconductor companies and the software companies don't want to make, but you need it for it to work. The switches, the electric, the thing that filters the electricity to make it a steady current, because the stuff that comes from utilities is choppy. They make all that other stuff, and the next generation of all this stuff is all fiber optic. So you're cutting the competition for this equipment down 90%, because most of the people that make this stuff make it with copper. And fiber optics is complicated. There's a bunch of companies who are exploding right now because everybody wants to go fiber optic on the next generation of NVIDIA equipment, because those NVIDIA chips work so fast that if you don't have every connection between the data and the NVIDIA chip fiber optic, you're slowing the computer down dramatically, and you're paying a lot of money for these chips and their speed. So you want all the connections to be fiber optic. These guys can deliver a completely fiber optic motherboard, and they've signed huge contracts. They're easily going to double their revenues in 24 months. They'll probably do it in 18. They've beaten all the numbers for the last couple of quarters, and why this stock has not taken off yet, I don't know, but I want to be on board when it does. And this is not some fly-by-night company. This used to be the motherboard manufacturer for IBM in-house. They spun them off as an independent entity, and that was the best thing they ever did, because it became a very good growth company where IBM's computer division was dull. Look at the 5-year chart here. Look what this company's done in the last 5 years. 2022, it was a $10 stock. $7 stock, 2022. 302 today, down from its high of 4.25, selling at a 19 multiple, growing 75%. Buy this stock. All right, next one is we're revisiting SMCI. And Matt Nervington, thank you for bringing that stock to my attention. I bought it myself today. SMCI. Eli in Brooklyn says, I should have bought this a week ago. Now it's up $10. Should I still buy it? Yes, Eli, still buy it. You want to know why? Because even though they reported great earnings, their forecasted earnings have gone up more than the stock. Let's take a look at the chart. Here we see when they reported earnings, the red dot here, it was a blowout, and the stock shot up from 31 to 40. I recommended it here on July 9th at just under 27. But this stock has been so beat up and is so cheap. Eli, I think the stock's going to $100. I would have no problem buying it here at 37. It's selling at 10 times earnings. It's growing 70%. Why is it so cheap? I couldn't come up with a good reason for you on Celestica, but on this one, I got 3 good reasons. First reason is the company was growing so fast, they're running out of cash. They just did a $7 billion secondary right here. This dip right here is the secondary. They paid off all their debt, gave them $5 billion to double their factory, and they now have a balance sheet that's not going to hold up the company's growth. Secondly, the stock melted down here back in November of 25 because their accountants, Ernst & Young, resigned, saying that these guys were doing improper things with their numbers. What were they doing? Well, this company is not supposed to book revenue until they send the client a invoice, and they're not supposed to send the client an invoice until the computer equipment is installed, it's running, and it's ready to go. Well, at half of the facilities they're delivering these computers at, they don't have the electricity up and running yet. They got to wait for the electric to work. On some of these facilities, they had to wait 11 months to build a client, which is one reason why they ran out of cash. And when that happened, the stock collapsed here. Amazon is not stupid. Amazon placed the company won't confirm this. They just say it's one of the larger hyperscalers, but Amazon's known for beating up its suppliers on price. Amazon made them drop their pants on price, and their margins dropped from 20% to 8%. But this quarter, they just reported the margins are back up to 17%, and it should go back above 20% with NVIDIA's new generation of chips coming out. This company makes the fastest server on the planet. If you want the fastest computer equipment available to do the fastest calculation of a compute question, you've got to have this company's servers. The third reason why this thing got beat up, and this was the drop here in March of this year, the senior vice president of sales and another salesman at the company got nailed selling this equipment to China. We're not allowed to sell it to China. They actually caught the senior vice president of sales at the Singapore airport with $2 million of cash in his briefcase. So the board has cleaned out the CFO who caused the accounting problems and the CEO. They've cleaned out the sales executives. Now, Hewlett-Packard and Dell are their 2 competitors. Their backlog just exploded from $30 billion to $60 billion. They reported $11 billion last quarter. Wall Street was predicting 9.5. Do you really think these companies would be buying this equipment if it wasn't the best on the planet? With all this garbage trailing them from a reputation standpoint? It's got to be the best box out there for them to be selling like they are. And because of these past problems, the stock's selling at a 10 multiple. Probably should be at a 30 or 40. But their earnings are going to rise so fast, that $60 billion backlog, and their ability to double their sales with this new cash infusion, they're going to be able to double their computer output. It probably will take 2 years to get to a 20-25 multiple. We'll put a 25 multiple on their earnings 2 years out. I'm getting a $120 target, and my target before they reported the earnings and their $60 billion backlog was 80. So Eli, going from 38 to 36 to 120 is actually more profit than going from 27 to 80. Sorry you didn't get in at 27 and your friend did, but I would still buy Supermicro here. I have no problem buying it under 40. There's a lot of great things to come from this company and this new management team. All right, that's all we got for this week, folks. May all your trades be profitable, and we'll see you down the road.